Compounders, Brad here. So Mohnish Pabrai just dropped his latest Q&A session. This was just earlier today with the Doctors Investing Group. You can see Dr. Tom here interviewing Mohnish Pabrai for almost an hour. So I'm going to share my highlights as always from this Q&A session. First, he's asked about how he started Pabrai funds. I'm not going to rehash that. He's talked about that a lot in previous Q&As. What is value investing, right? Value investing is buying things for well below what they're worth, okay? So this doesn't discriminate between value investing or growth investing. There's really no difference, right? If you're trying to value a company, you're incorporating the growth, you're incorporating the future cash flows of the business, which are determined in part by how much that company grows over time. So value investing is simply buying things for well below what they're worth. Okay, it's very straightforward. And Pabrai likes to go for the complete no-brainers, right? Things that are obviously trading for much less than they're worth. The first question one should focus on is whether the business is within your circle of competence. Now, what is circle of competence? Peter Kaufman was actually the first guy who laid out a definition for what circle of competence is. Peter Kaufman said, circle of competence simply means you can determine the odds of success with a particular action, with a particular investment. In this case, you can determine the odds of success. So you may understand a business, right? But if you can't determine the odds of success, with a long-term investment in that business, it's outside your circle of competence. And Pabrai says, if you understand the business well, you know how to value it, right? Being able to value it is part of understanding the business. So that's all pretty straightforward. He's asked about index investing. Index investing is a great way to go for almost all of us, okay? If you venture into individual stocks, 2 or 3 things come into play. One, circle of competence, right? You have to understand the business. If you think you understand the business well and you have the time, right? You have the time to do the work, to really kick the tires on the business, you could dig in and see whether the investment makes sense or not. The standard way I try to invest is a 10 by 10 portfolio. This is getting into the concept of diversification. If they're in a few different industries and geographies, that's plenty diversified, right? So if Pabrai has 10 bets, they're 10% positions each, say at cost. They're in a few different industries, a few different geographies. He's perfectly content that that is a diversified portfolio. He says one can be quite diversified with just 4 stocks, okay, or 4 businesses. And he's really taking this from Charlie Munger. So the Munger family has most of their money in Berkshire Hathaway, technically 1 stock. They've got Costco, they've got an investment with Lilu's Himalaya Capital, and they own some apartment houses, okay? So those are the 4 kind of buckets that the Munger family has money in. 80% in Berkshire, which itself owns 100 some odd businesses. So you might think, well, that's not really 4 stocks. It's not really 4 businesses. Technically it is, but it's a lot more diversified than what it seems if you just say owning 4 stocks. He's asked about shameless cloning, right? Pabrai has a reputation for being a shameless cloner. He says, I think shameless cloning is a good way to go. Globally, there are more than 50,000 public companies, okay? And, nobody can have more than maybe 5% of those in their circle of competence. But, that just takes it down to about 2,500, right? From 50,000 down to 2,500. if you look at concentrated bets from great investors, it cuts down that data set dramatically. Okay, so if you're looking at 13F filings each quarter, like I do here on the channel, with say a couple dozen great investors, it's a much smaller pool to have to sort through. Now, most of those still aren't going to be in your circle of competence, right? So you go from maybe 50 high conviction bets from great investors that have been bought recently. You're going to be tossing 95% of those out because those aren't in the circle of competence. So now you're down to a couple, right? Maybe a handful of companies to look at, which is very doable, right? For someone who's willing to put the time in to this stock picking endeavor, this active investing. It gives you a great pool to look at because it's already been through one filter by a great mind, right? There's been a great investor. They've put money down on this bet. They've kicked the tires. It's made it through their filtering process. And then, which ones are in my circle of competence at the end of that shameless cloning process. You could bowl with bumpers. I like this. You could bowl with bumpers and bowling might be more fun. You could bowl without bumpers and bowling might be more fun, but your score is going to be lower. Okay. If you think of bowling, right? Every once in a while, you're going to have a gutter ball. Most people, at least, who don't bowl regularly are going to have a gutter ball once in a while. If you bowl with bumpers, you're not going to have any gutter balls. And this really relates to what Buffett says, the first rule of investing: don't lose money, right? Those are the gutter balls. We need to avoid the gutter balls in this game of investing. It goes back to Charlie Munger with his invert, always invert. Most people are solely focused on how do I maximize my return, right? How do I make the most amount of money possible? If you invert that, you might ask, how do I avoid losing my shirt? Right? How do I avoid gutter balls? Well, simple. Only look at things that have already been bought by other great investors. So the whole thing here with bowling with bumpers, you could bowl without bumpers, might be more fun. Your score is going to be lower. Or you could bowl with bumpers, and it's kind of cheating, but you do better. Okay? It's hard for a lot of people, it doesn't feel great for your ego to bowl with bumpers. Because if you hit something out of the park, well, it wasn't really your idea. Someone else kind of led you to it. But, at the end of the day, you've got to ask yourself in this game of investing, are you investing to feel good about your ego, right? To hit home runs all on your own? Or are you investing to get to some financial freedom number, right? If it's the latter, probably a better idea to bowl with bumpers. He's asked about spawners. There are some businesses that have a DNA which allows them to enter new businesses and new markets. It's just part of their makeup. They have this spawning kind of DNA to them. The nature of capitalism is that almost everything will eventually mature and die. Okay? I mean, if you look back in the 60s and 70s in the US stock market, some of those high flyers, right? Companies that seemed like they were going to be around forever. If you look at those now, most of them are in the graveyard, right? They're gone. And that's really the nature of capitalism. If a company has the ability to spawn new businesses, though, they can potentially transcend this corporate life cycle. They can defy the corporate death. So that's a very powerful concept, especially if you are a long-term investor. If you can hitch your financial wagon to some of these companies that, keep generating new life, in a sense, to use a kind of a biological reference here. you can defy death in some ways, uh, not indefinitely, but if you can keep that compounding machine going for longer than most businesses would take to go through this corporate life cycle, that is an incredibly powerful thing to tap into as an investor. Amazon has proven itself to be very good at spawning new businesses. He says, I believe at some point there'll be a competitor to UPS and FedEx. Amazon's truck fleet is already bigger than FedEx or UPS. So Pabrai recently moved from Irvine, I believe, somewhere down near Los Angeles, to Austin, Texas. Okay, and so he took a road trip. During that move, he says, I recently drove from California to Texas, and just to keep myself from falling asleep, which is a very important thing to do while you're driving, I decided to count the number of Amazon trucks I saw versus UPS trucks and FedEx trucks. I saw way more Amazon trucks. At some point, they will enter that business. Okay? It's just in the DNA of Amazon to, try all of these things, all of these different business routes, opportunities, throw everything up against the wall to see what sticks. They have a lower cost structure because UPS and FedEx have unionized workers. Amazon has a bunch of entrepreneurs running its vans. They own the vans and tend to get paid per package delivered. So a very different structure than what FedEx and UPS have. Most companies are not good at going into new businesses, right? It's not part of their makeup. It's not part of their DNA. It's not a skill set that they have. In a sense, the business that they got into, they lucked out, a lot of them in some ways, with that business, and they don't know how to replicate that success in other ventures. I think if you make investments where the margin of safety is very large, so this is about inflation. He's asked about inflation, and he talks quite a bit about inflation, one of his positions in Turkey in particular. But on inflation, he says, if you make investments where the margin of safety is very large, whether inflation is 1% or 7% would tend to be a rounding error. Now, this is very different from how Buffett was talking about inflation back in, I think it was the late 70s, maybe 1977. Warren Buffett wrote an incredible article on inflation, how it swindles the equity investor. And Buffett back then was saying 7%. I mean, it changes everything. If you have a 7% rate of inflation and you're trying to invest in stocks. But Pabrai is really going for these businesses like Raisis in Turkey, which he gives as an example of why inflation doesn't really matter. When you're buying a business for 3% of liquidation value, like what Pabrai thinks he was able to do with Raisis, even a 50% annual rate of inflation, with the particular business that Pabrai bought, it's just, it doesn't matter. It's not going to be the driving force in whether or not that investment works out. And we'll talk a little bit more about that. He says there are businesses where inflation can be a tailwind. Okay, so, everybody's scared of inflation. What's it going to do to my investment portfolio? There's actually opportunities out there when inflation can actually be a good thing for those businesses. If you own real estate, inflation can be a tailwind. Rents will rise with inflation, but the costs don't, right? If you already bought all of the real estate, right? Say you bought apartment buildings, okay? And say you even have fixed rate debt on those apartment buildings. As inflation picks up, the value of that debt reduces. Okay, it's the banks that feel the pain in that situation. And of course, any other company that wants to build apartment buildings that are going to compete with yours have to pay higher and higher costs to build those. So effectively, the replacement cost of the asset that you own, that piece of real estate, is rising in an environment of inflation. Like I said, the asset is increasing in value, and a fixed rate loan is actually dropping in value. So this is a great situation for people who own real estate. That, obviously you've got to be able to maintain your tenant base for this to work out, and ideally increase rents in alignment with inflation. So Pabrai is going to give an example of an investment where inflation is very extreme, but it has worked out exceptionally well, and he thinks it will continue to work out exceptionally well. Of course, this is Rasis. It's a Turkish company with 12 million square feet of warehouse space in 82 different warehouses across Turkey, most of which are in the capital, Istanbul. And there's a bunch of other businesses besides, the warehouse business within Rasis. So this is really just one aspect of the business, but it's the easiest one to value, at least for Pabrai. So you have 12 million square feet, right? It's 99% leased long-term 10-year leases with blue chip tenants, Amazon, IKEA, Carrefour. The leases are inflation indexed, which means every year the leases, are increased in tandem with the CPI. Okay, which is obviously an incredible thing to be able to do in a high inflation environment, to have that feature of those revenues that are inflation indexed. He says it took about 10 minutes to do the math on Rasis. 12 million square feet. The construction cost at the time in Turkey was $40 per square foot. The cost of the land was $30 per square foot. Okay, so you've got $70 for construction cost and land per square foot. 12 million square feet. If you do the math, that's $840 million. That's what Rasis, that's what the warehouses were worth back when Pabrai bought in 2019. Now, there was about $200 million of debt that the company held. So you back that out and you got $640 million of value for a 20 million market cap. Okay, Pabrai was able to buy a third of Rasis back in 2019. So 20 million market cap, 640 million of liquidation value. Okay, this isn't intrinsic value, this is liquidation value. The other businesses have no debt, right? The other business lines that Rasis is involved with don't have any debt. They have the largest freight train network in Turkey, the largest truck network in Turkey. They have a forklift rental business. They have vehicle inspection stations. These are all monopoly or near monopoly businesses. When he bought, the expectation was that inflation in Turkey was going to be 40 or 50% per year. Okay, just insane to think about those kinds of numbers. And that's what panned out, right? Inflation from 2019 until today, it's 40 to 50% per year. So if there's inflation in the future, right, and I'm not building more warehouses, my warehouses are going up in value. My rent is going up, okay? So I can't lose. That's Pabrai's statement here. I can't lose if I have these inflation indexed revenues. Other companies that want to build warehouses, their costs are skyrocketing, right? The value of my real estate is skyrocketing because, it's all relative, right? Real estate is relative to what's happening with other real estate. So inflation is going to pull all of that up. The debt is at like 14 or 15%. Okay. But if you have debt, that sounds crazy, right? If you have debt at 14 or 15%, and the inflation is 25, 50%, that's actually a pretty good position to be in because the value of that debt is dropping. So the bank's not happy about that, but it's not a bad position for a real estate owner to be in. And an important point here, these 10-year leases, right? Now, inflation in Turkey, right? The Turkish government puts out inflation figures that are definitely on the conservative side, right? They're much lower than the actual rate of inflation that's happening. So the ability to raise these rents according to inflation numbers that the government is putting out, right? You can't raise them as quickly as you should be able to, right? It's not correlated with the actual rate of inflation. But every 10 years, you get to renegotiate these leases and you can actually mark it up to market, right? So you take each year of inflation. All right, where are we at after 10 years? We're going to renegotiate this lease at that price. So, it'd be nice to be able to do that in real time, but it's still powerful to be able to do that once every decade. A solar business, right? Races also spawned a solar business, which Pabrai thinks has added about 200 million to the intrinsic value. Okay, so there's just an incredible laundry list of assets here for Races. And again, this is all from Pabrai's mouth. Certainly do the work on this if you're thinking about buying into Races. And it's funny, the management team, they don't put out anything, right? They're not pitching this opportunity to other investors. They don't care. In fact, they've been some of the biggest buyers of their own stock over the years. So I don't know that they have a whole lot of interest in, pitching the value of the company to try to juice the stock price. But Pabrai, he's beaten that drum pretty hard over the last 3 years on Races. So, when you're able to find a company like this, when you're able to find an opportunity like what Pabrai thinks he has in Races, he says, only once in 28 years have I found something trading at 3% of liquidation value, but you don't need it to happen more than once or twice, okay? If this business gets to be 3 billion or 5 billion in 10 or 20 years, that 7 million becomes about a billion, okay? It's more than 100 bagger at that point. Nothing else really matters, right? If you have 100 bagger in the portfolio and you put a 10% bet on it, Pabrai couldn't quite do that because it was just too small of a company to be able to do that. He would have had to put in like 50 million to be a 10% bet. He was only able to get 20 million in. But if you can get these 100 baggers, right, these crazy dislocations between market price and business value, you don't need many, guys. It just takes one or two, and it just moves the entire portfolio. So if Pabrai were able to make a 10% bet on Races, and it is in fact a 100 bagger, that takes that 50 million bet to 5 billion. okay, which that would be 10 times what Pabrai's fund is worth today. So, and Pabrai has talked about, companies he's owned in the past that have done incredibly well like this, and that he's missed, right? He's missed the full ride on some of these bets. Like, he talks about Ferrari, that, it's not quite this extreme with Ferrari. I guess he owned Amazon, I think briefly in like 2004 or something like that. Guy Spear talks about his bet on Crystal. If he had simply held on to Crystal, it would be worth more than his entire fund today, just that position in Crystal. So it's incredibly powerful to find these multi-baggers, right? These 10, 100 bagger stocks. So, if you can just get one out of a 10 stock portfolio and have that patience to hang on as the company has its ups and downs, right, over a decade plus, that's really where the magic happens. And then just a last point here. He's asked, index investing. He's asked about the free lunch portfolio. And he says the free lunch portfolio is our take at an index with 15 stocks using 3 simple filters. Okay, there's kind of the shameless clones, that's one basket, the spawners, which we talked about, and the cannibals, right? Companies that are aggressively buying back their own stock. So that's something Pabrai puts out once a year, kind of this free lunch portfolio. If you don't have time, if you don't have interest in picking your own stocks, being kind of an active portfolio manager, this is an option. It's an alternative to the S&P 500. He says the S&P 500 is a great idea for most investors. Berkshire Hathaway is a good place to start also for most investors. So there's a few options, right? There's more than just passively investing in the S&P 500 index. It's maybe a bit of a scary time to be investing in the index, seeing how concentrated the S&P 500 is in kind of the high flyer technology companies in the US. So there's a few other options, right? Maybe dollar cost average into Berkshire Hathaway, or play along with the free lunch portfolio at Mohnish Pabrai's website, Chai with Pabrai. So that should do it, guys. There's kind of a whirlwind tour of this latest Q&A with Mohnish Pabrai. Always a treat to hear from Mohnish. And yeah, it's fun to kind of share what I've gleaned from it. Obviously, a lot of it repeats because good investment advice, there's not a ton of it, right? These tried and true principles tend to come up over and over in these talks, as they should. And doing this helps me really integrate those lessons and principles. So thanks for the opportunity to do this. All right, guys, I will see you all in the next one. Take care.